Time now for our market monitor, who says this is not the time to be chasing growth stocks in this market. He says investors should be looking at names that are much sturdier. He is Matthew Roddy, portfolio manager at Rockland Trust. Welcome, Matt. Nice to have you here.
Thank you for having me.
How do you define sturdier?
We look for companies with pristine balance sheets, consistently able to grow their dividends, really companies that have been through all types of market events and come out stronger on the other side. I think that's where we're looking for. Leadership, certainly in their industries, is obviously very important too.
All right, well, let's get to your picks. And it strikes me that all three of these may actually benefit because of all the rebuilding that has to take place in Florida and in Houston. Home Depot is the first one. You say consistently strong revenue and same-store sales growth.
Yeah, I mean, it is true that they're benefit, but we've owned Home Depot long before this, and this isn't a trade on that for sure. But, you know, they've got 6% top-line growth, 14% earnings growth. They've got 6% same-store comps. Other retailers would be so jealous to have those numbers. They've got 23% growth in their online business, and half of that's picked up at the store, so it's pretty protected from the Amazons of the world. They've grown their dividend 170% over the last 6 years, so a lot to like about this company as far as how they've run their business and executed.
You like Walmart. That's your second pick. You say basically it's not getting enough credit from the street. Why?
Yeah, that's true. I mean, this is the sturdiest of the oaks, right? If you're not going to reach out on that highest branch for growth, this is really a sturdy oak you can kind of lean against. You know, when you look at this business, it's having its best run of same-store sales in a while and traffic. Their online business is doing exceptionally well, too. It's been growing 67% last quarter. Really, they've grown it to be about 12% of their overall business. And most of the growth is coming through Walmart.com. Even though they've made great strategic acquisitions with some of the smaller parts of the business, I think they're doing a good job, and they're just not getting enough credit, consistently delivering. And, you know, if you looked at Walmart's valuation, it's making more money than Amazon, and it's $80 a share, and Amazon's priced at almost $1,000. So that's a pretty big valuation gap, I'd say.
Yeah, it certainly is. We rounded out with Sherwin-Williams, that you say that they have a great direct-to-consumer relationship, and they have pricing power, too.
Yeah, they did have some raw material costs sort of creep up in 2015-16. They acquired Valspar, I think, to help with some of that. They've been raising their prices this year. They found a lot of cost synergies in the Valspar acquisition, which has allowed them to grow their top line 20% and cut out costs. This is a year where their earnings are really starting to pick up for them, and we see that going out to 2018 and 19. On top of that, they've grown their dividend 130% in the last 6 years as well. It's been growing the dividend for 41 years. The company's been around since 1866, I believe. So it's a rock-solid company, leadership position.
On that note, thanks so much, Matt, for joining us tonight. Matthew Roddy with Rockland Trust. Coming up.